person responsible for analyzing the economic data that goes into a state budget forecast is the state economist. Dr. Laura Kalambokidis has held the post since 2013, and she joins me now to talk about the latest budget and economic forecast. Thanks for joining me.
Thank you for inviting me.
Minnesota's projected budget surplus, now at $17.6 billion, has continued to grow since the last forecast in February. To begin, was there anything that you found surprising about this forecast?
I think the biggest surprise that I've dealt with in the last couple of years is the persistent growth in tax receipts, and that with each forecast we are seeing receipts come in ahead of our prior forecast. So we raised the forecast, and then receipts continue to come in ahead of our prior forecast. And that was, starting out this forecast, that was probably the biggest surprise, that the starting point was higher than I expected.
The big story everyone is talking about is the surplus, but perhaps the more important story is the long-term health of the economy. Mm-hmm. The forecast indicates that we are essentially entering a mild recession right now, one that will continue for much of next year. What can Minnesotans expect from a mild recession?
Yeah, so the U.S. macro forecasters that we use are saying that there will be a mild U.S. recession, which means slower GDP growth. It's an investment-driven recession, meaning that slower GDP growth is largely the result of slower investment, so business investment and especially investment in residential housing, and that it will push the U.S. unemployment rate up. So what we can expect is slower growth for the state, and we should expect Minnesota's unemployment rate to get pushed up as well. But because Minnesota has a very low unemployment rate right now and still has high demand for workers, what we expect is that people will lose, there will be some job loss, but that it will create more churn in the labor market, that people will be able to get picked up by other employers.
So perhaps the unemployment rate in Minnesota will remain on the lower side.
Minnesota's unemployment rate is almost always quite a bit below the U.S. rate. So and it's historically low right now. So there's some running room for our unemployment rate to come up a bit before it becomes alarming. And yes, I do expect it to stay below the U.S. rate.
Well, and to say one more thing then about the labor market, because the report did note that Minnesota's labor market is one of the tightest in the nation. We have an aging workforce, and we also don't have lots of new workers coming in. How can the economy long-term continue to grow when there is that labor shortage?
That is a significant limitation, that labor supply is limiting employers' ability to add jobs. What can we do? Their demographics change is what it is, and we've been expecting it for a long time. So I think that employers should be and are looking to the pockets of unemployment that we do still have. They're thinking about flexibility. The pandemic, for all the difficult things that it caused, it did help employers sort of jump ahead in terms of being flexible with regard to the workforce. I think those kinds of things can help. International immigration is largely determined by the federal government. And so if the federal government opens immigration and a lot of those international immigrants come to Minnesota, that will be helpful too.
Minnesota's current crisis with a lack of affordable housing occurred in part because of the recession in 2008, when market conditions caused a significant slowdown in building. What impact will another, although perhaps smaller, recession have on the housing industry in Minnesota as we're still trying to crawl out from underneath the last, recession where housing was behind?
So yeah, trying to catch up some of that underbuilt housing. Two things are going on here. One is this U.S. recession that's expected to be driven partly by lower investment in residential structures, in homes. And so that's problematic if that happens here when we need more structures. On the other hand, this is sort of a buffer for Minnesota, is that our housing market has not been affected as much by housing market slowdowns in other parts of the country. And so our home prices remain higher than they haven't fallen as much as in some other parts of the country, the construction has continued even as it switched from single family dwellings to multifamily. So we might not see as much of an impact here, but that also means, so it's a multifaceted problem, that you know, if you own a home, then you're glad that home prices haven't come down as much. But it does hit, along with higher mortgage rates, it does hit affordability. And so affordability has been one of the strengths of the Twin Cities area relative to, for instance, the large coastal cities. And if affordability, if the Twin Cities become less affordable and Minnesota at large becomes less affordable, that is a problem for our growth. So affordable housing will continue to be the kind of investment that we can make that will help expand our workforce and help the economy thrive.
According to IHS, the macroeconomic consultants that the state uses, the CPI, the Consumer Price Index inflation, so it topped like 8.1% this year. It's expected to fall to 4.3 next year, then 2.7 the following year. After that, an average of 2.2 for 2025 to 2027. How tenuous is a forecast with such an optimistic inflation prediction? How do they know that inflation, which is kind of all over the map right now, will calm down later?
Yeah, there are so many things that are affecting inflation right now. A lot of it is supply side driven, and a lot of those supply constraints have been normalizing this year. So that's one of the reasons they were thinking that it would come down. But the main reason is that since our last forecast, and inflation spiked, the Fed has acted 6 times to raise interest rates with the goal of slowing the economy and reducing demand so that those prices do come in. And so IHS has in their forecast the expectation that the economy is going to really slow all the way to the point of a recession. And with that kind of slow growth in the forecast, they can expect prices to come down.
There is an expectation in the forecast that consumer spending will continue to grow. 2.7% this year, under 1% next year, just over 1% the following year. Consumer spending is responsible for growth in the economy. With inflation, then, does that spending amount to more purchasing power? Or is it just saying that goods and services will cost more? So in other words, are Minnesotans going to get more bang for their buck in the future?
So those specific statistics are about real or inflation-adjusted consumer spending. So they do say that inflation-adjusted consumer spending is expected to grow through this slow period or through this mild recession. And that's consistent with the idea that this is actually not a consumer-driven recession, it's an investment-driven recession. So consumer spending is the largest part of GDP growth, investment is the second largest part. And so consumers are going to, in this story, in this scenario, will continue to spend and have purchasing power while investment gets pulled back.
So this is just a strange forecast, I think, because we have this big surplus on the one hand, and we also have this sort of, I don't know, topsy-turvy, and yet there's a prediction that it will steady in the long term. In your view, is this an optimistic forecast, or is it accurate? Like, what's your whole take on this thing?
Yeah, so the hardest thing to do in forecasting is to forecast an inflection point or a point where things turn, either up or down. And we have seen in the last few years all sorts of inflection points, up and down. And so it makes sense that there's a larger band of confidence, larger error rate around these kinds of forecasts now, because we're not just forecasting that things are going to continue being the same. We're forecasting that things are going to change. So there's a lot of risk involved here.
Dr. Laura Kalambokidis, state economist, thank you so much.
Thank you.